Hey traders, Raghee here. Happy Tuesday, everybody. Hope everyone's doing well. Welcome to Charts and Coffee. Actually, today I am rocking from the city of Austin, a coffee called Super Thing. It's a mix of Ethiopian and Colombian. It's really, really good. They put a little roast date on it. Super, super good. That's what we're doing today. So that's one of the new additions to the coffee lineup here in the office. So good to have you all. Great to see everybody. All right. So as always, let's get to it. Couple things to kick off Charts and Coffee with as we get started is number one. Yes, we've got a long position in crude, and if you're curious about the explainer, how we did it, there's 4 ways to trade crude oil, whether you're a futures trader, an options trader, an ETF trader. The touchstone for the market that the symbol, more specifically, that you're going to analyze is always going to be the full-size contract of crude. So in this case, the CLU 21 contract. So CL is the full-size crude oil, U stands for September, logically, okay, and 21 stands for 2021, the year. So we're trading the September contract of full-size crude. So that is what we use to analyze, and then this is what we call it here in the office: choose your own adventure. Do you want to trade micro crude? That contract started last month. Do you want to trade mini crude? That's the half-size contract. That's been a long-standing contract. Maybe you want to trade the options on CL or the CL futures, or maybe you want to trade USO. So you might say, Rog, that's a lot. My caffeine hasn't even kicked in. What are you talking about? 4 ways to trade crude. Check out the video at the Simpler Trading YouTube channel. It was the update from the Simpler Futures video yesterday. So you can check that out sometime after the bell today if you'd like. And I'll walk you through. I gave you, actually, in that video, I gave you guys actually the trade that we took yesterday to get long crude. And so that's a position that we have this morning. And one other thing is looking at the possibility for a pit bull low this week. Now, as I mentioned many times, tendencies are not trades. Tendencies actually are just, tendencies. What is the likelihood for something to happen? And there is a higher likelihood, expectation, that the low going into next Friday, options expiration will be established sometime between Wednesday and Friday this week. That's the pit bull low, named after, for those of you that have read Market Wizards, named after one of the interviews in Market Wizards. His name is Marty Schwartz. Actually, the funny thing is Marty Schwartz, probably Larry Height, and everyone loves the Ed Seykota chapter. Those are probably 3 of my favorite chapters in the Market Wizards book. So if you haven't checked that book out, that's a classic. That's definitely one. Definitely inspirational, probably aspirational, not instructional per se, but definitely a great read. But anyway, and that pit bull low is named after Marty Schwartz, who kind of popularized this phenomenon. All right, so keep that in mind. If there's a dip to be bought, I would be looking for it Wednesday, Thursday, Friday. And yes, I know there's an entire segment of the investing universe and trading universe that's expecting this market, the S&P, the NASDAQ, to get whacked like a piñata. I don't know when that's going to happen. I don't know that it's going to get whacked like a piñata. But if the other two, if this pullback that hopefully eventually we get looks like either one of the prior two, you know what I'll be? I'll be a buyer, because that's a dip. And it's a dip because the underlying market structure of the S&P and the NASDAQ continue to be elevator going up. Okay. All right. So as always, that's kind of a lay of the land. As always, let's jump into your questions. Love it, my friend. Good vibes. Yeah, absolutely. Absolutely. All right. So Heather asked, can I look at AMT? Sure. You got it. So let's jump on. This is, by the way, the TradeStation platform. TradeStation is one of the 3 platforms that I use on on my rig here. I've got TradingView running. I've got Toss running. Occasionally I have Bookmap running, and that's more of a day trading volume tool. And I have Toss, Thinkorswim. And if you're trading futures, TradingView, Toss, TradeStation, they're all good. But see this little menu right here? I love this thing because it allows me to show you guys initial margin. I can actually start to show you all dollar amounts of certain types of moves. So, one of the things we were doing in, say, for example, bonds is looking at the risk of our current long position versus the width of the range, right? Versus the potential for upside. It's really good to remember what the overall trend has been yielding from top to bottom, right? And then if we were, so these are cool things you can do on. So I just thought I'd mention that. This is TradeStation 10. Who you trade through, completely up to you. Just thought I'd show you guys some of the tools. All right, AMT. So we'll jump over to TradingView, which I love this platform. This platform gets better and better every year. They're broker agnostic. It's just a charting platform, which is really nice. A lot of flexibility here. Really great mobile app as well. Okay, so let's see. Pullback on AMT. I like it. This was Heather's question. I like it, Heather. Why do I like it? Well, let's say it together. Double green. So we have this double green underlying structure in AMT. We have a pullback now, which is not that dissimilar to the 21 pullback that we've seen back on the 22nd of July and the 24th of June. So here we are actually touching the wave, which we haven't done since really early May. So let's be prepared for, I don't know if it's going to happen this way or if it's going to launch right off it, but at least let's calibrate and be prepared for something that could look a little bit more like May, which hung out in the 34 EMA wave for a little longer. So let's just going to presume it could do that and then, move higher from there for sure. We've got earnings in the rear view window, which is very important to me in terms of the market not having to be concerned about, in terms of the higher IV and the anticipation of earnings. So we've got earnings in the rear view mirror. We could even say this is a post-earnings pullback, which I love. And so, yeah, I like this one a lot. The only thing, if I'm going to nitpick and say that we don't have, is some sort of volume ledge. So good stuff. Thank you, Heather. All right. So John, yep, talked about crude. I'm long, distribution fade, not a trend follow. So are there pockets of setups that we look for that aren't trend follows? Absolutely. Crude happens to be one of them. But let's keep this in mind. Anytime you're wandering into a choppy market, well, A, you've got to know it. And B, so you've got to know the difference. And I think you all know that, especially if you're regulars here at Chart and Coffee. You know the difference between this and this. And the JT multi is clearly the easiest way to discern that. The idea, though, that in the context of chop, I don't have a primary or dominant directional preference is incorrect, because I am going to look at the trend that preceded the chop. What was the mood of the market before it lost the trend? Just because we lose a trend doesn't mean it flips. In other words, an uptrend broken is not, in fact, a downtrend. An uptrend broken is actually distribution. So in the context of distribution, aka chop, slop, call it what you will, overbought, oversold becomes relevant. That's where slow stochastics, that's where ready and fires are going to be especially helpful. Some of you like an RSI, whatever it is, that's going to be helpful. Where is that oversold trough? And that's what we've tried to take advantage of here, because we do have the clarity of the trend that was, right? That's straight up Charles Dow 101. This is 140-year, time-tested market theory. All right, what's a good, oh, right, sure, gold. I mean, I get it, all the interest in gold. Look, gold went a whole lot lower than I thought it would go, because the last time we played gold was right in here, right in that area. And I wanted to do it again, but we gapped lower through our entry. So those of you in the sector secrets know about, I don't know, 10 minutes after the bell rang, I said, hey, look, we know there's 4 things that invalidate the trade setups that I send out. And one of them is gapping through the entire set of triggers, aggro, moderate, conservative. And so what we need now is an inside day. Now it's starting to look actually really interesting. Today's candle, if it's going to likely stay an inside day. A harami for those of you that are Japanese candlestick fans. So we've got this harami potential setting up. This shows that the market is finally settling down, right? Panic is a really difficult thing to step into. Now you might say, Ron, what's the difference between this move lower and the dips that you want us to buy? Great question if you're wondering that right now. The structure is the difference. The underlying market structure in gold since June has been chop. How do we know that? Thank you, JT Trend. Thank you, Grab Candles. So the other thing that I love about where we are right now on gold, and is it my favorite thing to jump into? No. I mean, this is not the number 1 market on my list. It's number 9, it's down the list. However, look at the volume ledge. Price without volume is an incomplete look at participation, commitment, conviction, whatever you want to say. Where have people dug their heels in to the long and short side, right? But that volume ledge around 1730 and change, very, very interesting. Now, today's not the setup. Today would be an aggro setup. Today is not actually when I want to get in to gold. It actually will be tomorrow on a play of the inside day. Today's fine, but you've got to calibrate to, okay, aggro position, maybe 1/3 to 1/4 of my overall budget for the gold. And so GC is then going to translate over to GLD. Notice that I'm not doing the analysis on GLD. I've been trading futures for 35 years at this point. And what I will tell you is the markets that are tethered to the commodities markets, which are, from a volume perspective, far larger than the equities, far larger than stonks. I love stonks. But the futures contracts are more 24-hour. They're more global in terms of the opinion. And they're going to be your touchstone to GLD. Okay, so thanks for the question on gold. As far as, Dave, strategically, I will tell you this. It's a great question you ask. When we're in the zone for an entry, like we are in GC right now, when we're in the zone for the entry, remember that whether or not you want to be a long call trader, which I am I'm 95% of the time, long call, long put, directional debits. That's the way I play the options game. Very seldom am I in multi-leg strategies. I mean, almost never are we in multi-leg strategies and say the sector secrets. I'm straight up long call, long put. And I know a lot of people feel, well, gosh, Rog, you can't win unless you write credit. Not true. Not true. I think a whole lot more pitfalls befall traders who feel that somehow their options are more resilient and better because they've got this credit angle to it. I don't believe that to be true. Now, credit is fine if that's what you want to do. But my friend, I am straight up long call, long put, directional debit. Because if you don't get the direction right and you don't get the timing right, I don't care what multi-leg strategy that we're going to execute. It's not going to be as effective as someone just having really good timing, blue light special, picking a direction, buying a call or buying a put. So, but the interesting thing is this, in that same zone that I'm simply buying a call, it's usually going to be pretty good for put credit spreads. It's going to be good for legging into a vertical spread. I only really use 3 strategies. There's a few variations of some strategies like vertical spreads that I use. They're called strips and straps, and I consider them to be basically a lopsided vertical. Maybe we'll get into that sometime in the future. I have a very unorthodox options position type mentality, very unorthodox, but it works. Strips and straps, if you've never looked them up, they're real, they're not Ragheeisms. Check them out, they're lopsided verticals. It's a way that you can offset the cost and reduce the risk of the trade, but you're still very much betting on a very specific move. So As far as just a call, yeah, I'm fine with that, Dave. I'm totally fine with that. And I know a lot of times people see naked call. The show is PG, G even, no worries. But naked calls are just directional debits. You've bought a call, not short. Naked shorts, clearly there's some self-loathing going on. I would never recommend naked shorts. Selling an option without the safety net, without the parachute, clearly that is a position that just is, you hate your money at some point. Anyone out there doing that regularly, you hate your money somewhere deep, deep, deep down inside. You and your money want to part ways. I do not recommend short naked, ever. However, long naked is fine. Your risk is defined to what you paid for the option and commission. That's it. That's it. So whatever you paid for the option, if you're long a call or long a put, whatever you paid for the option, that's your risk. Okay. All right. Now, I'm not getting into if it's in the money at expiration and all that kind of stuff. Yes, I'm not talking about assignment or anything, but just I think that directional debits have been maligned for far too long. And funny enough, that's almost exclusively what we do because I'm just not a complex carbohydrate when it comes to my trading. Well is interesting. Well Tower, Foxtown, pullback. So I'd say we're probably doing something more akin to what we see in May of this year. Maybe it's going to chop around a little bit. It's got some nice volume ledges at 85, but it also extends down to about 83 and a half. So keep that $1.50 range in mind. I will not be surprised to see some red grab candles on well. Again, look at the previous, I mean, we have this here, beautiful 21, bounces right off the 21. So something about that 21, if we hit it and it bounces, that's a shallower retracement, and it seems to be quite resilient. However, when we break the 21 or the 21's not visible, we see something more like we saw in the beginning of May. So let's consider this a playbook that would be more Mayish, okay? And I think if you keep that in mind, the other thing we'll probably see, and that's something to keep an eye on, keep earnings and dividend dates on your charts, because we might see the market move higher into that dividend date, but it's not unusual to see a little bit of weakness after dividend date. And that would probably suit us just fine because again, your range is is a little bit lower than where we are right now. And I don't see a problem with that at all. Yes, it's a yellow market, but remember, respect the trend that was, and that means the current sideways market that started here in August. Well, what preceded it? An uptrend. Here's chop. What happened after the chop? Most trends like to continue. So if a trend breaks and it moves yellow sideways, and I'm just referring to the colors of the JT Multi, we've got a sideways consolidation or congestion market, the higher probability expectation is for the trend that preceded the chop to regain traction. All right. So that is it. When scaling out of XLC, hey there, Darius. When scaling out of XLC, which has been one of our favorites for weeks now, when scaling out of XLC, for example, after the pullback buy, what's the first best target? Never new highs, right? Never new highs. So let's talk about what's not a first target. Never new highs. We want to retrace the steps that the market's already made. So we're long. So all my cards on the table, we're long XLC. So this is the play on Facebook and Alphabet. And then my initial target's going to be basically, where have we already been? Don't expect new highs. Pay yourself while you can, not when you have to. Don't make the first target require brand new highs. I think that's tactically an error. And I do this intraday and end of day. And then T2 is going to be way out in the stratosphere. So if you guys have never heard me talk about T2 before, a lot of you will know, what do I call T2? And this is from, I believe it's called A Good Day. It's a Russell Crowe movie. It's a really good movie. A Good Day. And I call T2s, straight from the movie, greedy bastard mode. We are entirely too greedy on the first target and not greedy enough on the second. So make your first targets far more prudent. Just let the market make a move towards levels that it's been able to hit before. Pay yourself move the stop to break even. Don't let a winner turn into a loser. And then T2, stratosphere, right? Be much more ambitious, because at this point, you've paid yourself, you've controlled the risk, you have the house money. Now's the time to start managing the trade, like, well, to use a baseball analogy, that you're ahead on the pitch count, right? That's the way you look at it. I'm ahead on the pitch count. If I'm the batter, there's 3 balls and no strikes against me, all the pressure's on the pitcher. I can play a different game at the plate. That's where we are at T2, if you want to use the baseball analogy, which I love to use. All right, gang, have a great one. I will see you all tomorrow for Charts and Coffee once again. By the way, all the charts and coffees and the replays are available at the Simpler Trading YouTube channel. So if you haven't checked it out, if you haven't subscribed, definitely do. You get notified about all the different shows and videos that we post at the channel. All right, be good to each other. I will see you all in the futures room momentarily. We're going to be doing the open here in just a bit. And in the meanwhile, be good to each other, gang.